to give what I think is going to be a super fun presentation today about the secrets of the ultra wealthy and how the 1%, or let's say the 1% of the 1%, are investing. It's going to be a fun conversation. Now, don't think that you are off the hook for participating. This is not me talking at you. I want a little bit of a dialogue here. So I'm going to be asking questions. Make sure to jump into the chat, put some of your thoughts, your questions. But the first one, let's just start out. Where are y'all calling in from? Love to see where some people are coming from. And we'll get started in just 1 minute here. Dallas, let's go. The Metroplex. We got Austin, Texas. Texas is representing here. Oh, Boston, Mass, Orange County, California. Yeah, we got coast to coast. I'm obviously in Orange County, so good. I'm glad we got a good regional diversification. So real quick, I'm going to start jumping right in here. I don't have, when I put this on full screen, I'm not going to be able to see the chat. So Pietro is going to help moderate and we'll jump in. But there are going to be some questions that I ask of you guys as we're going. I'd love to hear, what you're thinking, what you're participating with. The same goes for people listening and watching on YouTube. Drop in the chat what you're thinking, answers to your questions. I love to see how you interact with some of this content, and we'll moderate after the fact and jump in and have some conversations there. So without further ado, I'm going to put this up. All right. So real quick, let's start with a riddle. This will be a fun way to start this out. Now, picture this. An entrepreneur has a massive exit, right? Maybe it's an IPO or a sale, that kind of thing. And suddenly this person is sitting on billions of dollars. They could retire, they could cash out, they can go live on an island and sip coconut and eat fish all day. But instead, they roll that fortune into assets that pay them every month, whether the stock market goes up or down, by the way. They never sell these foundation assets. When liquidity is needed, they borrow against the assets so that the wealth keeps compounding tax-free. And they set this up so that their family and their kids and the kids of their kids and their great-great-great-great-grandkids are the beneficiaries of this portfolio 100 plus years from now. In the chat, who am I talking about? I'd love to hear if you can guess which entrepreneur I'm talking about, or which ultra high net worth person I'm talking about. Elon Musk. Okay. Danny says Trump. Yeah. Any other guesses, guys, as to who this might be? I think there might be a few different answers there. Naval Ravikant. Ooh, I like that's deep tracks. I like that. So the answer is, this could be Rockefeller in the 1900s. It could be Elon. It could be Larry Ellison in the 2000s, right? The Oracle founder. It could be Bezos right now. It could be Oprah, even with her media and real estate empire. Lydia Resnick of the wonderful company. I mean, the point is, it's not one person. This is the playbook that so many billionaires are doing to help compound and create dynastic wealth. And the backbone of what they're doing, it's structuring in real estate and it's structuring in alternative assets for a whole bunch of different reasons, from cash flow, tax efficiency, control, things like that. But what I want to talk with you guys about, and where I really want to engage, is like what we do with this kind of information. Whether you have $1 million net worth or a $50+ million net worth, the same rules and the same strategies that these people take can apply to us to help us get ahead, to help us create wealth for our family, for our kids, even maybe our great grandkids, if we do them right. So what I want to do is talk about some of those principles about like what we can take from this and what we can learn. Ultimately, this presentation is for entrepreneurs and professionals who are looking for kind of building into their wealth strategy. And maybe you're already passively investing. Maybe you're just getting started here. Maybe you're curious but skeptical. Maybe the market's a little sketchy right now, and it's hard to tell, which way the wind blows based on crazy tweet storms from, different people, right? the truth is the best investors are not waiting for the most ideal conditions. They have principles, they follow them, and they ultimately win over years and years and years, regardless of where things are in the cycle. And I get it too. Like I've been in a place before in my life where I was grinding away, working in startups. I mean, flying coast to coast, raising money to build companies, and trying to figure out, where can I build wealth maybe outside of my startup. I didn't love that a debt crisis in a foreign country could absolutely obliterate my stock portfolio that seemed to have nothing to do with it. I didn't like the feeling of not really having control. I didn't feel like I was really being all that tax efficient with my investments. And that frustration for me really led me to learn about how the ultra wealthy invest and try to model them and study them and see like what are they doing that might be different than a high net worth investor than who I am essentially, right? And again, you don't have to be in the billionaire category to get a lot of value from looking at what they're doing and thinking maybe what can we do for ourselves. So I eventually learned how to do some investing in some of the categories that the ultra wealthy do play. Looking in real estate, I started as a limited partner 10 plus years ago on my first deal. Now I run a company called Ocean Ridge Capital, helping entrepreneurs and high income earners to essentially channel into overlooked multifamily real estate opportunities and really building enduring wealth, cash flow, tax efficiency, that kind of thing. But at the end of the day, this is about the patterns, right? It's about looking at like what ultra high net worth people are doing, understanding what those are. And I've distilled everything that I've been able to find into what I call the 10 commandments of the ultra wealthy. So excited to go into that. And we'll talk a little bit about like some of the different, beliefs and mental habits around how high net worth people might think versus how ultra wealthy might think. So let's jump on in here. Okay, so what the 1% focus on? And by the way, I'm going to use the vernacular, the 1%. Again, I'm talking about, 100 million plus. That's probably above the 1%, but it's a lot easier than saying the ultra high net worth every time I say this. So we're just going to kind of go with that. Anyway, what is the number one thing that could ultimately destroy a billionaire's wealth? I love to hear, maybe in the chat, what do you think is the biggest enemy of a ultra high net worth, of a 1% of a 1%'s portfolio? I'm just going to go off screen and see what you guys say really quick. Yannick says taxes. Yep. Tax fraud. Yeah, that actually is. Divorce. Oh, yeah, these are big ones. Absolutely. Really, really good examples. I would argue that the 1%'s biggest fear is actually inflation. And it sounds super not spectacular to say this, right? It's a little different, right? But at the end of the day, you have these enormous amounts of assets that get built over the course of a lifetime from a very, very successful type of ultra high net worth person. And, there's a certain point where you get smart enough on tax strategy to figure it out. You get smart enough on, lifestyle choices or how to structure so that your family isn't overspending and that doesn't become the biggest risk. But inflation, this, little 2 to maybe up to 5% a year thing, is actually the biggest opponent of wealth. And let me give you an example as to why this matters so much. So one of the core principles of the ultra high net worth class is that they think in generations. A lot of the like high net worth investors, and I know I've fallen into this category at least before I made this presentation, I kind of think in terms of retirement. I'm sort of thinking like 30, 40 years out. Ultra high net worth are thinking 50, 100, 200 plus years out, which is crazy when you think about it. But it actually makes so much sense, because if you look at what inflation could do, even if you just took a 60-year time horizon, we went back and said, hey, in 1965, 60 years ago, maybe someone has $100 million fortune. Well, if you could get that thing compounding at 10% annually, $100 million 60 years ago is worth $30 billion today. It's almost unfathomable, the purchasing power of what that can do relative to having it investing and compounding, right? But take the other side of the coin. If that was left uninvested in cash, maybe they hid it under a mattress or think it's a little too much money to hide under a mattress, but they put it in the back of the bank vault and it sits in cash. After looking at the impact of inflation over the 60-year time horizon, they would see a 90% loss in purchasing power in those $1965. Now, they still got some money in there, but that's like $9.7 million in real purchasing power today. It's just staggering, the 10x impact of what inflation can do to completely erode a dynasty's wealth. So this is critical to the playbook of the ultra wealthy. So what does that actually mean when they go to focus on things? Well, one, future growth matters a lot. This is about looking at the horizon and actually what horizon you're optimizing for. What kind of assets are going to ultimately sort of build for you, and not just like chasing short-term moves and trying to make quick bucks, but locking assets that value, that compound in value over decades, right? Really good example of somebody who's done this is Donald Brin. I don't know how many people are familiar with the Irvine Company, but this is a real estate entrepreneur and investor, actually local to me in Orange County, bought up a ton of Southern California land in the mid 1970s. People said he paid too much, but he had vision around basically owning and having the economies of scale to build this complex of retail development, shopping centers, apartment complexes. And now he's one of America's richest real estate entrepreneurs, valued at something like $17 billion, and basically owns most of these things outright, because he chose a horizon and an avenue and basically a what to compound as being like a really efficient way of saying, like, it doesn't even matter what trees we plant today, because he wants to have trees that his grandkids can go under at that point, and really delay gratification to having the right vehicles to drive the compounding. Number two, and you guys said it in the chat, tax savings. This is critical. Now, here's kind of what's a different mindset philosophy that a lot of ultra high net worth have versus like retail or high net worth investors. Taxes are not an afterthought. They're actually kind of treated like an asset class. And it's really unique to look at that, in that saying, maybe for us, right, like we'll sell some stock and it's like, oh, we got to figure out how to pay the taxes after the fact. I wonder if there's something I can do to shelter some of that. These, 1% thinkers are saying, let's actually get in front of that and actually like go from the get-go with tax savings already being baked in. And you have some great examples from like Sam Zell, the grave digger who built the grave dancer who built his empire on, finding lots of different distressed real estate plays and finding ways of just having tax-free gains rolling through vehicles like 1031 exchange and leveraging depreciation. I mean, even famously, Trump, whether you love him or hate him, is a great example of this. I'll share another kind of anecdote on this. I had a previous career in food tech, and it spans into sort of bigger tech too. I've spent some time on Google's campus before. And it's really interesting. If you ever walk around Mountain View, you'll hear a lot of Irish accents. And it's kind of unexpected. You're like, why are these people Irish? Like, that's not like a typical developer hub or anything. Like, what are they doing? It's because so much of Google's revenue goes offshore into Ireland, which has more favorable tax laws than the US and most of the EU. And they actually have such a tax strategy to keep their basis down. That's a corporate strategy, but there are people that are taking like dynastic approaches for their family, doing the same kinds of things. Number three is wealth longevity. This is, again, I kind of mentioned earlier, but they're thinking in a very different time horizon than us. They're thinking in centuries. You have some really great examples of groups like Rockefeller, who set up trusts that basically said their kids could only take a certain amount of money out of a trust every year, and they had to take it in a loan, so that it never really killed the golden goose that's actually laying the egg. And now you have something like 200 plus Rockefellers, 100 something years later, that are still have these trusts intact, that are living dynastically in America. And a lot of it is because of the planning that was laid, 100 plus years ago, and creating longevity for that fortune. And finally, compounding. Now, not to mix this with future growth. When I say compounding, I'm talking about the actual engine of the assets and what they're doing. So the future growth, we're talking about let's pick the right assets and make sure we have stuff that's going to compound. Compounding is make sure you don't stop the engine, because we are looking on the horizon decades and decades out, and we don't want to prematurely stop the compounding mechanism. And there's some really good examples of how the ultra wealthy will leverage compounding without having to sell their assets. I mean, look, he's been all over the news this week, so it's relevant to say like Larry Ellison and Oracle. You've seen that stock going crazy. But one of the things that he's done, this guy has built a real estate empire. I mean, essentially he bought like an island in Hawaii. Do you think he sold a bunch of Oracle stock to do that? No. He borrows against his ownership position in Oracle and takes low interest margin loans to buy his real estate. And then he's able to basically pay it down over with cash flow and things like that. So he's not trying to stop his Oracle compounding. And as a result, he gets wealthy and wealthier while simultaneously building an empire of other assets to ultimately sort of build that out. This is super, super relevant. And it's actually something that a lot of us can get stopped out at, because we tend to get a little more influence with volatility and things like that. The reality is we're going to find out in the 10 investing commandments in the next slide, volatility may not actually be such a fierce thing if you know how to ride it out. The fiercer thing might actually be stopping the compounding before it really reaps the gains that you want. Cool. So the 10 investing commandments of the 1%. I don't think these are written on scripture, or if it is, they're written over the Bugatti on the background here. But I think there's a lot that we can pull away from some of these things here. The first being, again, this time horizon is really key. Try not to think in terms of retirement. Think in terms of years and years out, and how to optimize for long-term horizons. Legacy over lifestyle being kind of the key line there. Number two, this is kind of an interesting one. And actually, let me ask you in the chat or in the YouTube chat, what do you think is the percentage of Warren Buffett's top 5 holdings? Like, you look at everything that Berkshire Hathaway owns, at least what we know they own publicly. What percentage do you think the top 5 holdings are? I'm going to X this for a second. Look at what you guys are saying in the chat. Oh, we got 90% and we got 5%. That's a pretty big spread. Interesting. TJ says 10%. Okay. Cool. All right. The answer, at least as of March 31st of this year, is 64% are in the top 5 stocks. That doesn't sound all that diversified, does it? And actually, historically, it's been more like 70 plus. So one of the niche the points here is that focus really beats like fragments. We get kind of sold this notion of like doing a 60-40 stock to bond portfolio and all these pie charts. The reality is, concentrated bets in niches that we understand really well can actually be a really powerful notion for us. And you see a lot of examples of the ultra wealthy doing this, particularly with their alternative asset strategies, their private equity holdings, and sort of core single companies, as opposed to like very, very, very broad kind of holdings. Okay. Number 3, protect the downside. This one's pretty obvious, but you really can't fix a bad buy. I mean, maybe a long time horizon helps you there. But the reality is, I mean, this is, again, like a Buffett rule. Rule number 1, don't lose money. If you forget rule number 2 is, if you forget, go back to rule number 1, right? This is so core. It's just buying right. I don't know that I have to belabor this point, but defense drives dynasty, right? Is like a major part of this. Okay, create the deals, don't shop them. This is another really important point. And you see a lot of ultra high net worth, not just taking what's on the market per se, but actually finding a way to make the deals that they want. I mean, the Irvine Company example that I gave before with Donald Brent is a good one. You have a lot of different examples in real estate of people doing this, but it's about like saying, hey, we're not going to just take what's there. I'm not going to look on Robinhood. I'm not going to follow the stock headlines on Business Insider, as much as like, I'm going to engineer asymmetry and find something that's not already available and maybe make it available, right? We do some of this in real estate, by the way, especially if you're looking at off-market deals. This is kind of like making your own deal and making asymmetry. But you see the 1% kind of obsess over this, and it's a key point that a lot of high net worth investors can kind of think about. Taxes, like I said, asset class. Don't just make it be the afterthought. We sort of talked about that already. Liquidity isn't everything for this group. These people generally have a decent amount of cash flow and compounding coming in, but I would suggest that they value control more than they value just cash flow. Now, you have to have cash flow to show viability, right? But at the end of the day, if it came at the expense of either having liquidity or control, I think a lot of high net worth, ultra high net worth are going to side with having control and being able to maybe be a little less liquid, but ultimately, steer in a direction of something that can continue to compound for them. Borrow, don't sell. We talked a little bit about this too with Larry Ellison borrowing, but you see this a lot, by the way, with the ultra high net worth. They don't want to stop the compounding engine. And, again, for us with volatility, you don't want to do the same either here. A lot of these high net worth folks will actually build their own family offices and institutions. They won't take anything that's off the shelf. And you see, especially the Waltons, the family behind Walmart, doing this a lot. It's kind of an interesting approach of basically making your own mini corporation. Now, philanthropy is one that I would say is one of the biggest differences from how like a high net worth person would invest versus a ultra high. They see philanthropy as influence. This is power. This is shaping the world the way you want to make it. And this is showing dynastic influence. A lot of high net worth folks will see this as sort of the leftovers, the crumbs. Hey, if I can make enough, then I'll do this, right? And to some degree, a huge amount of money will create the world that you want. But there might also be something in even starting at a micro level and saying, look, I want to shape, a localized influence through philanthropy where you don't have to just contribute millions of dollars a year, but you actually make it part of the core strategy. And the last one, play to write the rules. This is, again, about having control and dynastic influence. Wealth can bend industries. It can change the rules. It can change the political landscape. It can change culture. Whereas, a lot of high net worth and retail investors, we're kind of looking for freedom, right? We're sort of saying, I want to maybe have money, when I retire coming in. Ultra high net worth is saying, I want control and I want influence. And that's a big difference of the two. So let's look at how this actually plays out in allocations here. And then this is kind of directional. Obviously like everybody has a different portfolio, but high net worth, we're going to talk about like the 1 to 10, maybe $1 to $30 million people. Ultra high net worth, we're 100+ million, right? And one of the differences you see is that alternative assets make up just an enormous proportion of the ultra high net worth investors' portfolio. Alternatives mean real estate, private equity holdings, commodities, unique stuff, classic cars, wine collections, crypto, all sorts of stuff like that. By contrast, you have a really heavy over-reliance on public equities in retail and in high net worth. And there's a couple of reasons why. So, again, we're building on those last slides, right? But time horizon is key. We're, high net worth thinking in terms of retirement. But at the end of the day, if you're thinking about longer term, 100+ years, daily liquidity and having something that you can pull out of stocks at any given moment isn't as important as compounding wealth over generations. So the high net worth people, we're investing for freedom, but ultra high, it's dynastic, it's control, it's influence. Number 2 is about risk mindset. So typically we're trained to kind of fear volatility, and a lot of people get emotional, sell when markets dip. Ultra high net worth fear permanent loss. That's totally different than volatility. They're using debt as a tool to protect equity and compound, untaxed. So they actually might embrace volatility if the long-term return profile is better, as long as that downside is survivable. A lot of this also has to do with taxes. These alternatives can tend to have really good tax strategies. Tax arbitrage as an asset class. Real estate we know is awesome, but even some of these other alternatives. I was looking at a music royalties deal a couple of weeks ago and found out that music royalties have a 10-year depreciation schedule. As random as that sounds, that means you could essentially, get paid 10% of your money every year for 10 years untaxed, as long as you can fit certain parameters, right? And that's the kind of stuff that a lot of these folks are looking at. And then lastly, obviously being control. Real estate, private equity, a lot of those things you can control a lot better than whatever is moving your stocks up and down. So this is also kind of a directional way of looking at things. This is called like a spider diagram, but you can see these different attributes that might impact how would you classify like an asset class, from diversification to risk-adjusted returns and correlation to other assets, inflation hedging, that kind of thing. This is how you would sort of say, like in the red, you'd look at stocks, private equity in the purple here, and real estate in the green. So take a second to look at where this stacks up. And again, we're building a little bit on past performance here. That doesn't necessarily mean this is always how these things go, but you can get a pretty good directional sense of what's going on here. Stocks are liquid, they're high growth, but they're volatile, and you don't have control. They're really tied to the economy because of that ability of having liquidity go in and out. If people are scared, they're pulling out quick. Private equity, great absolute returns, but a liquid, decently high failure rate, and super long lockups. So you could kind of think of it like stocks are a little bit like the roller coaster, but you can't really design the track. Private equity, I think you'd say more like kind of like a lottery ticket. If it hits, you're in. Maybe it's not as much gambling as that, but it's higher risk, higher absolute return. And then it comes to real estate, right? So unlike private equity, real estate's paying you, along the way. Some of these private equity deals might just be for equity growth. You have uncorrelated economics with stocks. That's going to really help to sort of decouple some of the things that might be happening in the national stage. Risk-adjusted returns in real estate are good. So this is actually a really key point. When you actually look at the risk that you're taking on relative to that compounding vehicle and the horizon that you're building for, real estate has a really, really good profile for how that can ultimately look for both protecting your downside and being sort of tried and true and steady to build on that upside. And there's ultimately a volatility buffer. I mean, I know we hear a lot about like 2008 and things that happened when, things were pretty volatile. But the reality is, this doesn't happen very often. And you have sort of a basic human need in real estate that, ultimately it's not really so much a roller coaster as much as like a little bit of a steadier asset class that just generally consistently delivers over time. Got a couple more slides here to share, and then we'll open it up for Q&A. So why does the ultra high net worth class love real estate? This is kind of interesting. Like I have a 4-year-old and 2-year-old daughters, and we picked up the storybook the other day, and it was the story of the tortoise and the hare. And I started kind of thinking a little bit about this presentation. I shouldn't do so much of that. I'll make another webinar about how to live more intentionally, whatever. Real estate, I felt like, is kind of the tortoise, and stocks are the hare. And in a way, like the hare is quicker, but it doesn't go off track. And, the hare kind of like goes and does something different sometimes, and it totally sets you back, and it runs back to the starting line, and then on the other side, you sort of have the tortoise that's just marching ahead, slowly compounding, just goes kind of in a straight line. Ultimately, it's steady, it compounds, it survives the storm. And I think that metaphor sort of translates into this being a really good strategy for sort of slowly but methodically compounding generational wealth. So the reasons why this group loves real estate, we all know real estate has active, sort of attractive cash flow. Depends what you're investing in for the amounts here. But again, you see, this being a very viable sort of thing that these people love to just see monthly or quarterly yield. There's a really good optionality on controlling forced equity appreciation and actually creating value, not just waiting for markets. This is a lot, by the way, of what we do at Ocean Ridge. We try to find stuff that's just overlooked, and we really build into it and make it better and try to ultimately optimize its value. You see tax advantages in real estate probably is like one of the, if not the most tax favored asset class I can even imagine. I mean, there are so many different ways of being really efficient with taxes and gains here. that ultimately the wealthy just really, really love this asset class. Amortization, meaning debt pay down and having your tenants literally pay down your debts over time. And that's a longer term equity build too. And lastly, is you have this sort of lower correlation to stocks and to the economy as a whole. What's interesting here is even in something like affordable multifamily, you tend to see something like if the economy goes down, you'll actually tend to see a lot more renters because people might lose their home, unfortunately, or people need a place to live, or they downscale a little bit, and you see them coming into that asset class. If the economy is booming, well, people tend to have more money. More people might move to the city, chasing higher paying jobs, got more renters. It just kind of works in any direction, right? And so that's a major value add for a lot of these ultra high net worth in that north of 40% of their allocation, looking at real estate being a core component of that. For one of the last slides here, couple tactics. I would be remiss not to share what some of these people are doing. Buying below replacement cost being key. So if it costs, let's say, $100,000 a unit to build a property, they're trying to buy it for $80,000 or $90,000 a unit. And in some cases, by the way, you can even find deals that are $40,000 or $50,000 a unit. We look at quite a bit of things like that. But it's really about like being the floor of your buy. If it protects your downside, you've already done a lot to sort of advancing that compounding strategy over time. Underwriting like a skeptic, not taking hopium, right? This is really key. You just can't put hope as an underwriting strategy. And so if you consider that what is bad could happen and you can still buy it, generally speaking, this is going to be a really core thing that the ultra wealthy will do when they're buying their real estate too. Structure over return. This is probably the most important of anything on this page. So we've seen a lot of these deals in 2020 and 2021 that have kind of gone sideways because of floating rate debt that was maybe 3-year duration or 4-year duration. And it went from 3% to 7%. And all of a sudden the property's rents can't support the debt payments. And we're seeing some turbulence from there. Ultra high net worth people are generally a lot more focused on structure, and so are institutions in real estate, by the way, than they are on total absolute return. They would take like a 12 or a 14% return with long-term fixed debt and really good fundamentals over like a 20, 25% return a year when it's swinging for the fences, right? And there are things that we can also do to think about this too, because ultimately their number one is don't take a total loss. Structure is critical to this approach, and it should be for anybody's real estate deal, as we're looking at investing as well. And last is tax advantage asset protection. Again, such a great asset class for this. I am not a tax professional. Don't take tax advice from me. There are just so many strategies here that you should ask your tax advisor about, from Delaware statutory trust and 1031 exchanges that can roll gains tax-free. There are family limited partnerships, layered trusts. I mean, the tax code is written for real estate. And there are so many opportunities to take advantage of this in your unique situations. It pays to invest a little bit of knowledge to really build this direction and figure out how to take advantage. Last slide, and we'll go into Q&A. This is a little more about timing. And, we talk a lot, like it's not about timing the market, but time in the market. It's also hard to decouple away from just looking at core level fundamentals when they're so apparent and jarring. We have we're sort of in an interesting moment right now. You guys saw the announcement yesterday from the Fed lowering rates by 25 basis points. That makes it a little bit cheaper to borrow. It opened the door for potentially 2 more drops this year and maybe 1 more next year. What was interesting is they didn't say 5 more next year or anything like that. But what that basically signals is there's sort of this near-term window where borrowing should get less expensive. And as a result, asset prices should increase because there's more buyers that are able to afford them. Now, at the same time, the last 3-4 years, because of how expensive it's been to borrow and to build new products, we're ultimately at a place right now where we have started to decline in the amount of new multifamily supply that's available on the market. And there's not a lot of new building coming up in the next couple of years, because essentially I think it takes maybe 2 or 3 years to build a complex. Well, that would have to get started just today, right? So we're in this unique sort of juxtaposition where rates and borrowing costs are getting lowered. The amount of supply that's available is going to start going lower, 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 but the demand is still high, and it's actually higher. It's projected to be higher than the actual supply available. That's what leads to rent growth. That's what leads to asset prices increasing. That window does not last for that long, because building eventually comes back online and meets demand or even exceeds demand. Pay attention to this, because we are in a closing but available window to buy maybe some of the best deals that have been out there in the last 20 years. Anyway, I'll pause here. Let's do a little Q&A. Love to hear what you guys think of the presentation, any questions you have, that kind of thing. Ooh, that's an interesting. How does the wealthy deal with crisis time? The ultra wealthy. That's a good question. So is that about in terms of like a financial crisis, or like a personal type of thing? 2008. Oh, I mean, you've seen Buffett and his shift over to cash, right? And that's kind of a recent event. You tend to see the ultra wealthy trying to capitalize into these moments of extreme volatility. And a lot of us felt, 2008 as a stock type of event. I mean, maybe some of us were a little too young to be trading or investing at the time, but it also rippled into the job market. It also rippled into private equity valuations, real estate valuations. Those are generally the best real estate, private equity, stock, whatever buying opportunities that you can have. So typically what you'll see is a cognizant awareness of that from the ultra wealthy, and a land grab. So long as they have the liquidity to do so, it'll be a whole kind of a feeding frenzy when the bottom goes in on those kind of financial crises, and there's a lot of buying activity right near the bottom, or as things start to stabilize and emerge out. That's almost the dream. Alex says, fantastic presentation. I'd love to dive deeper into the ultra wealthy mindset. Oh, I love this question. Are there any books or resources you'd recommend for further study? My favorite book on how the ultra wealthy think. I mean, a lot of people talk about Think and Grow Rich, right? Napoleon Hill being a key sort of catalyst, particularly in our real estate community. I really like this book called The Almanac of Naval Ravikant. And the reason is that Naval is this venture-backed startup guy and founder. He founded Angel List, which has done a lot of early stage tech type investments, but he's basically distilled a whole bunch of his tweets. It's like a very innovative book, 3 chapters, health, wealth, happiness, dialed into very, very, very actionable nuggets. Naval is the person that taught me about the 3 forms of leverage. That being basically, how do you use leverage or compounded judgment to amplify your returns on something? So if you think about it, like you have good judgment and you have leverage behind it, you could do really, really well financially. You can make a really big impact. You have bad judgment, you have leverage, you could lose a ton of money, right? And it's like the Charlie Munger quote, what are the 3 things that cause people to lose money? It's like leverage, ladies, and liquor, but he just added ladies and liquor because he added to put 2 more L's or whatever. Anyway, if you have good judgment, leverage is unbelievable. And you're talking about either using labor leverage, which is people, having people that are working for you on your behalf, great form, but people can walk off the job. People can take specific knowledge with you. People can compete with you. So, not a perfect solution. Second form is capital leverage, right? That's a lot of real estate. That's a lot of, what we're talking about with private equity and alternative assets. The ultra wealthy get this, and they leverage capital a lot. However, also not a perfect form because debt markets dry up, especially like in those 2008 type times when it's the best buying opportunities. That's when it's hardest to get money to go buy something, right? So can have some challenges, and obviously capital leverage can go against you if you have bad judgment. The last form of leverage is permissionless leverage. That's digital, that's code-based. That's what we're doing here. I can shoot this webinar, put it online, and 1,000 people could see it. And it's an amplification of one effort many, many, many times over. This is AI. So if you think about like how to take the mindset of ultra wealthy, a lot of it comes down to, thinking different ways, but a lot of it comes down to using specific tools deliberately to advance the thing that you're trying to do. And I think from that book, the Almanac of Naval Ravikant, and what I've learned about leverage, especially, it's 10x the impact I can have in the world in a much smaller amount of time. I think the ultra wealthy really get this kind of thing. TJ says, do you see an opportunity to buy with transfer of wealth from boomers to younger generations? It was interesting to hear that most ultra high net worth families don't look to sell or cash out on their portfolios. This is a really, really good question. And I'm not going to say that my crystal ball is going to tell us all the answer here, but we could sound it out. So do we think that the transfer of wealth is going to create buying opportunities? Yes, absolutely. I mean, there are trillions of dollars that are going to change hands, not just in our lifetimes, but like in the coming years, like in the near to midterm, as boomers get older, start selling off portfolios, start dying, things like that. And who is going to want their real estate, their companies, whatever those things are? Some enterprising inheritors will take that and run with it. Others are going to say, I'd rather be a TikTok influencer. What am I doing with this HVAC company from dad, or this 180 unit deal in Springfield, Missouri? Like, I just don't want this asset. And that's going to create a lot of selling. So the question, there are too many factors to see, like, is that going to create the buying opportunity of our lifetimes? It's certainly going to create dislocations. And that's an interesting play. Because again, if we're talking about protecting the downside and making deals before they're on the market with the broker, these are opportunities to maybe find the boomers that are retiring or getting close to the end of their lives and making deals to help them out of their situation, acquire their assets maybe that their kids don't want. Those are awesome opportunities to build and grow our own wealth, and also to help people out of situations that might no longer be serving them. So I think a lot of opportunities to come, and there are obviously ways to serve this community too. Senior living is going to start to heat up, and there's a major demand and supply imbalance there. Lots of different plays in that too. That's like a whole nother webinar topic, but yeah, great question, TJ. Well, if you guys don't have any further questions, I'll leave you to it. Really appreciate you showing up on the presentation. For those that want to follow on more, we released an ebook recently called the Passive Wealth Playbook. You can find it at passivewealthplay.com. It spells out a lot of different things about how to invest in real estate, diligence processes, and you can really take, what we talked about here into an actionable domain of saying, how do we really apply this, the nuts and bolts of a strategy? I'll also share, we're actively working on some different and unique allocations within Ocean Ridge Capital. We don't have anything today, but we have some things coming down the pipeline that look really, really, really interesting and really good. So don't hesitate to reach out to me directly to book a strategy call, to connect, to talk about how you're thinking about allocations for the next year, that kind of thing. Appreciate you all. Thanks for showing up, and we'll see you on the next one.